Okay, everyone, thank you for joining today's show. Today's show, I was looking to talk about the Buffett Indicator. Now, this is something that's kind of new to me. I wasn't really fully aware of the Buffett Indicator, and I listened in recent news events and things how they were using this to measure the economy and things in the USA at the moment. And I wondered to myself, how does that relate to us in the UK, and is it transferable? And when I looked into it a bit more, it's quite interesting. Now, for anybody that's unsure, the Buffett Indicator is obviously been something that's developed by Warren Buffett. And what it reveals is a lot about wealth creation, market cycles, and investment opportunities and things. So I thought it was quite relevant for us to talk about it. And I'm sure you're aware of it already, Jim.
No, I'm not.
You're not.
No, I'm not. This is kind of new to me. I'm quite actually surprised there is something called the Buffett Indicator.
I'm glad to hear that, because when I seen it, I thought, God, how have I not heard of that? And when I looked into it a bit more, I thought this is a good topic to talk about. So
it's possible. It's possible. I would imagine it's probably just an indication about how he sees the overview of what's happening, and is it really a mathematical formula? That's the sort of thing I'd be wondering. But let's go into it a bit more, because there are. I mean, the reality is there's thousands of economic indicators, isn't there? But and is this really as powerful as them, as the Buffett Indicator? Is that really better than them? I mean, what I would say is what is the one question it tries to answer?
Well, when you do research it, and they pitch it as one of the most powerful economic indicators. But what that question I think you're referring to is probably, are the financial markets becoming quite disconnected from the actual real economy?
And if you look at AI and the AI boom and what's going on, and the reality is like, how are you going to monetize AI to be able to have the proper return on investment? Because AI is costing an absolute fortune to put the infrastructure in place. It's like, how is that going to be economically viable? And the jitters are actually happening right now, that people are actually getting a bit nervous now because these questions are becoming a bit more real overall. So are the financial markets becoming disconnected from the real economy? I think they possibly are.
Yeah, especially when you look at things like AI and things as well. So, but
what then answer my next question then. What is the Buffett Indicator? What is it? Is it a formula? Is it what is it?
Yeah, well, it's interesting how you said like about an actual, is it a scientific or a mathematical equation or whatever? But the way they work it is the stock market value, the total stock market value divided by the GDP, and then times it by 100. So just to break it down for people who are listening and think, right, well, what's GDP and things as well? GDP is a measure of an economics output, and then stock market value is measured by investors' expectations, and then that ratio compares financial optimism with the actual economic reality.
Yeah.
So and you can, and then that equation, obviously, stock market value divided by the GDP, and then times it by 100.
Okay. Right. Okay. Well, just let's see how we get on. So, total market capitalisation in the UK stock market, often represented by the aggregate value of domestically listed companies in the London Stock Exchange, is approximately 4.11 trillion. Okay, or roughly 3.3 trillion pounds. That's $4.4 trillion. This is according to ISI Markets. Represents over the vast market represents over 1,400 companies, broadly measured, that indicates the stock market, the total stock market value. So that's where it is right now. The all share index, 3.3 trillion. Now you're saying GDP. So what is the total GDP, and what is the total GDP in UK?
Approximately
2026. 2026 is a whopping, okay, approximately 3.14 trillion, almost like for like.
I was just going to say they're just about the same, actually, yeah.
So you've got that. So what we're taking stock market value divided by GDP. So stock market 3.3 divided by 3.14 equals 105%. Or 105, yeah, 105. So in simple terms, measures economic output, stock market value. Can markets, the ratio compares financial optimism with economic reality. But what is good and what is bad when it comes to that? Do we have some sort of, can we talk about that? Is there something here that tells us that? If it's a good measure, what is the best measures of the Buffett Indicator? You know, what does it mean?
Right. That's where when you look into it, it's quite interesting because it throws up a lot of questions, and makes you look at things a wee bit differently. Let's have a wee look at.
Okay, here we go. How to interrupt the numbers. Overvalued, dangerous, 120% plus. Fairly valued, 75 to 120%. So we're kind of all right, but we're it's a balanced, because 75 to 120%, we're sitting at 105. That's almost middle of the road in terms of fairly valued.
So fairly moderate values.
So it kind of tells us the UK stock market overall, the whole company stock market, because we're not heavily involved, our stock market, in AI, whereas NASDAQ is. So if you took the value of the NASDAQ and all the rest of it, and the USA, it'd be interesting to see the USA. I mean, do we have time? Let's do it.
Let's do it, because that was the initial thing that brought it to my attention, because they were using the Buffett Indicator, looking at the USA economy at the moment.
So what is the total? What is the USA total stock market value? And it is $75 trillion. So 75 trillion. And what is the USA
GDP?
GDP. Which could go horribly wrong.
So well, I'm getting 32.
Nominal projected 2026 33 trillion.
Well, 32.8, yeah, 33. Round it up.
So, this is, I could see what's happening here. Divided by 33, you're talking about 227%, and they're saying at 227, it's grossly overvalued when it goes 120% plus. So
approaching 200% plus.
Ours is quite well. Let's talk about what this actually means. Now we've got some sort of thing. Why should investors care about this? Why should they care about that?
Yeah, and I think that's for the people that will be listening to us or viewing. It's how is it going to affect us on the, on the night?
Honestly, to say 105% is the Buffett Indicator in the UK, but it's 227% in the USA. That's quite frightening.
Which, when you look it up, is a major warning sign.
So the Buffett Indicator is not designed to predict what will happen in the next week or month or two. The value lies in helping investors understand the broader environment in which wealth is being created. And wealth has been created in the USA by the hype, and I would have a good guess of this, of AI.
Yeah, and it's good to look. If you look back historically, if we look back at, like, say, the 90s, where technology, shares soared in technology.
There's a surprise, technology shares again,
And then valuations became really quite detached from actual earnings and things as well. So we've seen a repeat. We've seen a repeat of that thing, And at that time, investors believed that the traditional valuation methods no longer mattered, and they just thought. But really, they should have thought differently about that at the time.
And the same argument appears during almost every major market boom, which is the AI now. And it was the same with the dot-com bubble. It was the same with the technology shares thing as well. And so we could see it all happening again. So my discussion here then, the point I would like to make is, does human nature change? or do investors simply repeat the same mistakes in every generation?
Well, it looks like if the numbers and the trends are anything to go by, it looks like people do make the same mistakes by emotional decisions.
So what does everybody else think it's tuning in? I would like to know your thoughts in the comments. But more importantly, my judgment of this is, I think what happens is, and I've always kind of believed this, and I've always seen evidence towards this, and most people will actually understand what I mean by this, is as a new generation comes along, they don't remember what happened previously, and they've never experienced it. Therefore, they just go ahead and they're quite bullish in their outlook. So that, you know, they become the Wall Street bull sort of thing, and they're like, optimistic. Whereas people that have been through this become quite bearish towards it. In other words, quite conservative, not borderline pessimistic to the view, because they've been a bit jaded about it. Would that be fair to say?
I think that's probably fair, but then that's probably the thing that keeps them above board, rather than, I mean, it's good when new investors come along and they're enthusiastic and driven, but sometimes that could be their downfall.
Well, that's what they need to keep it going, doesn't it?
Yeah.
It's a bit like the aeroplane game, isn't it? Where you get new recruits to sit in the seats, and you become the captain, and you get the payoff and the rewards, and then you keep recruiting more people, and the people sitting in the seats eventually get moved up to be the captain, and they get the rewards about getting people to sit in their seat before, and it's kind of like getting other people to buy the shares at the higher level that you bought them at low level for you to make the profit. See how that works?
Yeah.
But what happens when the aeroplane crashes? A correction comes along.
And have to start all over again. Yeah.
AI. That's quite worrying about the USA market and the Buffett Indicator. That tells you a lot about where they're and that this is almost could I really say this is almost like a credit crunch problem?
It's a wee bit reflective of what happened then.
Because remember the overvaluing of everything when you look at that Buffett Indicator, and if that is, listen, somebody might tell me these are different figures, but I'm just getting them off of Google straight away from what are accurate sources, as I can see. So somebody might tell me something different, and that percentage might be different, but that's actually really worrying. That means that because remember, people will be borrowing on the strength of this share value in America. And therefore, the banks will be exposed as a result of that if the share value starts to drop for that reason. So if there is a correction and there is a burst in the AI bubble, then that could have a major impact on the financial markets overall, which could have a knock-on effect like it did in the credit crunch to the rest of the world.
Yeah. So the thing about the Buffett, obviously it was the USA economy, the thing that brought it to my attention, and the whole point was, for me, how would that look like in reflection to our economy? And when you look at the Buffett Indicator with the UK economy, it is slightly different, because when you apply it to the UK economy, it creates some interesting challenges and things when you do it, because unlike across the United States, a lot of the major UK listed companies generate, large proportions of their revenue overseas, whereas it's so like Shell and HSBC and Unilever and things like that. So we do a lot of overseas stuff, which is different from the USA.
Yeah, I mean that. That makes absolute sense, doesn't it? This creates the debate about that. So I suppose the question I've got to ask about that is then. Should the value of global companies listed in London be measured against UK GDP when much of their income is generated elsewhere?
See, I would argue that if the income's generated elsewhere, it shouldn't be. Do you think?
But they're a UK company. Remember, the income comes to the UK
and
adds to the value of the UK. It's like me arguing all the time about what happens in your local community. Is if it's a corporate that comes in and its shareholders own it somewhere else, what happens is the money is then taken out of the economy and of the local economy, because there's it's like you're depleting a fund which is in to look after that local economy, which everybody basically trades on that fund, and that fund gets smaller as a result because corporates come in and then they take that money out and they spend it elsewhere. So that money then moves to another area and they become more prosperous because that money's there now. This is why I keep arguing about the fact that if people do leave this country to go and live somewhere else, even though the UK assets will be taxed here for them, we'll still get the revenue off of them. But when they get their dividend, they'll spend it somewhere else.
Which is taking a lot of people,
and their income. If you get a lot of people doing that, then it's taking money out of the supply in this country. That's the point. This is so important to know that. I think does the indicator really work better in America than Britain? Because I tell you what, if that isn't in America, shit's going to hit the fan.
I think it's with what I've looked at so far, I think it's a wee bit more accurate in the United States than it is when we apply it to the United Kingdom. But like you say, if it is more accurate and that's the numbers we're looking at, then America's in trouble, and that's what that was the topic of conversation that kind of brought it to me. So I thought, God, if they're in that much trouble, that they've got a tough time ahead.
Well, they won't indicate they're in trouble, but there has been people obviously saying they believe that AI stocks are completely overvalued with no valid reason. It's just sheer hype and frenzy and FOMO that's driving that market. And because it's so inherent to America and it's embedded in America, that's probably where the problem lies. That's maybe why. I mean, we all know. Well, I don't know if you're aware of this, but that's why certain companies list on certain stock exchanges, because they know it'll be worth more. Their shares will be worth more in a different country on their stock exchange than it will be in maybe our country. That's why they do that, for that very reason. So it boosts the value of their company, because their objective is actually, the director's objective is to increase the value of the shares for a shareholder. Their responsibility is to shareholders, not to anybody else other than the shareholders as corporate officers. That's why they're directors. That is their responsibility.
So it's amazing how hype, like you were talking about, the AI hype, how it could influence its value or something's value within an economy. And it's like even a certain president for a while there, as soon as he even said certain things, would have an influence on markets. Did the oil and things? It's like just because one person said something, that because that had so much following and so much hype around it.
It is. A lot of this is consumer sentiment.
Yeah,
when it happened, and I knew that it was consumer sentiment. Hence the reason why I've spoke about this before. Why Trump opened his mouth first time round, and the market dropped about 10% or 15%, and I immediately went in and bought a big chunk of stock in my pension. Remember, and then I even got the money added on as and the tax added on, and then a month later it was recovered. Hey, 15 to 20% made in a month. Wow, what a return on your investment. And then that's when I then, then what I do now, I could take out the full tax-free element and it could buy me a house and I could rent that. So the Inland Revenue bought a house for me and gave me it for nothing. So I could earn more money off of that. And that's where you use it. But coming back to this is where it all happens. This is consumer sentiment. But personally, for me, I tend to focus on spending less time predicting what would happen and more time assessing, is there true value in what I'm going to buy?
Yeah.
We've done it this morning. We've talked about there's a portfolio of properties available in a chunk, and I've looked at the numbers and I'm going to look at them again, but I might actually consider it seriously.
Because I was both quite surprised about the numbers.
I was pleasantly surprised, and that's why I was working at the downside first. Is like, what happens if this happens and that happens? So I could factor that into my numbers. But I've not done anything yet now. But I'll do that later on and look at that over the weekend. But I might even go for it, or I might recommend other people to go for it. And that will give them an investment without actually having to lend anything from the bank. They could just put their money in joint venture and earn a really good income out of that portfolio as a result of that. So I think these are the things. So when you assess the value, the three areas I would commonly focus on would be the valuation of the stock it currently stands, the cash flow they're generating as a result, and the long-term trends in that market where it tends to be going.
Yeah.
Because if the company doesn't have cash flow, they're not going to be able to do anything. If they're full borrowed to the hilt, then they're going to have a problem. And that's why you get, for example, let's look at SpaceX. That's why that launched. That's why that was the whole point of the flotation of SpaceX, was in order to get more money to invest in more projects. That's why Amazon famously never make a profit, because all the money keeps going back in to generate even more business and build the business even bigger. And therefore the share value goes up as a natural result of that. So anything made gets reinvested straight away. And that's why the never making a profit thing is not anything to do with they're trying to avoid tax. It's because they know the value is in the share value, the value of the company itself. And that will bolster their cash reserves as well, because, and that's exactly the same thing as I do in my portfolio. I don't take anything out. And folk are going, but what was the point then? It's like, because it bolsters the value and it allows me to borrow against the asset as a result. And that is tax-free to generate that income.
Because when it comes to investing, you've talked about obviously the valuation, the cash flow, and the long-term trends. And it's like, so is investing really about, is it an intelligence and that kind of approach, or is it about discipline and having control over your emotion and being in it for the long term? I'd say it's a bit of a balance between both.
Definitely.
But definitely that discipline and the control over your emotions to change and just sit tight for a longer period of time, that long-term trend, that's where then, as you say all the time, compounding comes in. And
so let me just explain to you then, because you've just said that. Is it primarily about intelligence or about discipline and emotion? And it is both. It's all of it. And the reason for that is because I know for a fact, and history has been all the time, when you have active fund managers, and that's like people that are making short-term gains and investing and all the rest of it. It's 95% of just like index funds. So no active fund managers on them. They're just buying shares, keeping them for the long term. 95% have actually outperformed the active fund managers. That tells you everything. Sustained growth is done steadily over long periods of time, and allowing compounding to benefit as a result, and just make the smaller the returns, but compounded over a period of time, far outweighs the erratic,
short-term gains.
Ups and downs of the short-term gains. Because I do mention the short-term gains is an ups and downs market. You're taking far bigger risks than when you're doing long-term and doing for that. Could you give us an example of that? 10 grand invested, what would that come out? 10%?
I mean, simply, if you've got, say, £10,000 and you put that in, invested in, with a 10% annual return, after 10 years, you're looking at 25, probably about near enough 26,000.
So look at that. So after 10 years, you've made 15,000 on top of it after 10 years. That's no bad.
Just no bad,
So what happens if we let that compound in for, say, 20 years?
Well, another 10 years. For 20 years, if you could hold tight in the 20 years, you're up at about 67,000.
So you've just added 57 grand on.
Yeah.
So it's gone from 15 in 10 years to 57. Now, normally everybody would go, wait a minute, if it's done 15 in 10 years, it'll be another 15 on top of that for the 20 years. But it's not, because the money that's constantly in there is actually getting reinvested every single time, and that money is making 10% as well. So every single year that money gets left in there, it makes 10% and 10% and 10% and 10% and 10%. And then that 10% makes 10%, 10%, 10%, and that 10% and 10%, 10%. And it just goes repeatedly all the time. So,
and this is how it's like the 1p doubled up thing, and the compounding.
So let's take it. Let me throw that spanner in the works here and say, let's take it to 30 years if you did that. So if you had 10 grand invested for 10% to 30 years, what would that come to roughly?
You're just shy of £175,000 over the 30 years.
So 10 grand, 10% over 30 years is £175,000 for for most people, that would have solved their problem 30 years ago for their pension.
Yeah.
Just putting 10 grand at the beginning and just leaving it in a really good fund.
That's why you're always saying about, if you're doing pensions, get them started as early as you can, or even any investment, start as early as you can, because you need to give it as much time as you can to compound that.
I definitely think, and I would say, not say most investors, but just most people in general underestimate the power of time, and overestimate the importance of market timing.
Yeah.
I think time's the most important thing. It's like just repeatedly putting the same amount in every single month into a fund and actually just letting it compound. It has been shown every single time over history that has outperformed on the majority of cases, the erratic trying to time the market.
And delaying and holding back for periods of times, looking for that right time is time that you could have been compounding your investment.
Yeah, you could be compounding that money, so you're losing the compounding. Dare I say, and we can take an example of this, as property, look at the amount of times landlords actually leave their property empty for ages because they're refurbishing them. And the amount of rent that gets lost every single month because it's empty. When they could have paid a contractor probably less than what they've lost in the rent, and they could have had it finished within that period of time, and the property would be compounding nicely and generating income. That has happened a lot. And the other one is landlords that actually go, I tell you what, what's the market rent? Oh, it's 800. Well, try and get 850. And then they could try to get an extra 50 quid, and they lose 2 months because they're trying to get someone, and they end up settling at the 800 quid. So they've lost the 50 quid anyway, but they've lost it over the 2 months, which is 800 quid times 2, which is £1,600. So they've lost £1,600 because they try to go for 50 quid. But if you try to get that 50 quid extra, the 1,600 you've just lost is actually, it takes you 32 months to get it back, which is almost 3 years.
Yeah.
That's how it's crazy. Trying to go to the top of the market and get the maximum rent. If it's going to take you roughly an extra month or 2 months, it's going to take you ages to try and recoup that. Plus the fact, and the more than likely the tenants no settle, because if they see a lower rent somewhere else, because you're at the peak, they see a lower rent somewhere else, they're going, I'll tell you what, I'll just move.
Yeah.
And then you've lost the tenant and you're back to another void again. This is why voids are so important to avoid. Excuse the pun.
No, you're right.
It's mental.
The longer the property is empty, and I thought we could go on and talk about property a wee bit more, because obviously it's look at how like stocks and property and wealth creation are all kind of related, and that relationship between the markets and property itself.
So stocks, property, businesses, and cash is what we want to really look at there. Let's look at the advantages and the challenges of each one. What would be for property?
Well, property, I mean, you kind of touched on a wee bit there, but property has got a lot of advantages. Firstly, you could use property to leverage your position greatly, depending on what your strategy is. You've got that cash flow, rental income, and it protects you against that inflation as well. I mean, recent years have showed us that very well, with inflation jumping up, but property has a protection against that.
But then I always argue the principle of if you've got property, it has to be a long-term thing, because liquidity is no great, regulation, and then you've got constant maintenance as well. So it has to be a long-term project. It can't be a short-term thing unless you're doing flips, unless you're buying, refurbishing, and doing it within a short period of time in order to get that gain at that point in time. Because if you do a flip over a year and it takes you a year to do it, the market could be completely different in a year's time. And it could be the other way rather than the better way.
Because the numbers you've originally worked out might not be the same in 12 months' time.
Yeah. And this is where I come on to debate about stocks as well. And this is why I have stocks, but in a divest fund, in a UK equities fund almost. I've got Standard Life UK equities, which is Glencore, BP, all these different Diageo. It's a diversification. And the advantage of that is I within 2 or 3 days, I can actually cash that fund if I wanted to.
Yeah.
And I did when I took the tax-free element out and bought another property.
Yeah.
Again, tip of the cap to HMRC for free. Give me a property for free.
Yeah.
That's a crazy concept. Eh? It's like you built up that fund and then you get a tax-free element and you go and buy a property. So you basically got a property for free. It earns money and appreciates and capital appreciation over the long term. Mental.
And people would argue when you talk about stocks and things, Jim, and you're obviously saying you've got a diverse fund and things, but people would argue there's a lot of volatility with stocks. But then again, you kind of mitigate that because you do it over the long term. You wait on the if things change, you just wait on it doing a full circle, comes back again.
They always go. They're blue chip. They're great earners. It's like that's what you need. Look at Buffett. I mean, we're talking about the Buffett Indicator, but let's talk about Buffett himself. Buffett's Bank of America, he's Coca-Cola, he's McDonald's, he's Geico Insurance. That's all repeat purchase products. And that is all volume product as well. So you just need to say, I tell you what, I'm going to put 50 pence on a transaction, or I'm going to put 10p on a transaction, or 10 cents on every transaction that goes through the bank. They were talking about billions of transactions. You put 10 cents on, you've immediately put that right to the bottom line. Happy days. That is the difference. So that's where, stocks can be volatile if you're picking them. But if you do a standard fund, an index fund, in a safe index, I mean, NASDAQ's technology stocks. Yeah. So I'm not a big fan of that because you're entrenched in that huge swing, but there also could be a huge swing the other way as well. Whereas S&P 500 is meant to be stable, but the S&P 500 is heavily influenced by the technology stocks as well now, especially when you see, the 227% in the Buffett index. But then when you look at the UK equities index, I mean, we're all, blue chip and companies, and we're not hugely invested in a huge amounts of technology in our index fund. So that's where we get a plus, and the volatility has disappeared as a result. And you maybe get I think over the longer term, you'll get a better result than over the short term. I tell you what, when I was on Necker, I spoke to a fund manager who manages a family fund for him and his family and other people that are invested in him. And he manages in stocks, and it's about 400 million.
Yeah. Now, he said to me, I said to him, what's your return every year on investment then? He says, probably about 20%. And I went, okay, that's fair enough, 20%. And I said, so what are some of the things you're investing in now? And he went, well, we're actually looking at asteroids now for mining. So, and it's through a NASA company, and investing in that. We're invested in Ring.com, which proved to be a real winner for him. And that's why Jamie Siminoff was there at the time as well when I was there. So that made sense. I says, but do you ever get some losers? He went, yeah. I said, so what's the proportion of winning and losing? He went, it's about 50-50. I went, all right, okay. I didn't think it would be a split like that. I thought
it's about 50-50. Some actually come out really smelling the roses and good returns, and some won't be as glamorous and just tank.
Yeah.
Mining asteroids possibly might be that one. But they offset to give a 20% return. And he says, so what do you do? I went, well, I think I actually probably get more than a 20% return, and I just do nothing. Just bored.
Rather than keep trying to change it up.
And I used the pun, and it's safe as houses. He didn't realise I was involved in property. But it says it's just like being safe as houses. And he went, yeah, housing's really good to invest in. And I went, yeah, it is really. It pays well, and it's pretty boring. It's the way I like it. And so see that. So he's running about like a headless chicken, trying to find all these new opportunities for all these investors he's got. Whereas I'm like, I'll just pick that one. Okay, that one makes sense. And I just think long-term planning all the time. You can get caught up in this, though. You can get caught up in that, saying, well, where's your end game here? I mean, when are you going to exit? Because obviously the exit is the difficulty. When you've got tenants and properties, you can't just say, well, I'm get rid of you all, and then suddenly I'm selling.
Some will shift and some won't.
That takes a long time to do. Plus you've got a lot. So it's like, well, I'm never exiting. It'll just go on as a legacy to the next
kids and the next generation.
to what I want to do, is the foundation I want to build as a result for the community and for certain groups of people in order to help them get a good start in life. That's sort of things I want to do. So you look at that and you look at this overall, it's not just one answer to your whole investment strategy. But coming back to this key question about, when the Buffett Indicator suggests expensive shares, could property provide these better opportunities?
Yeah. And I think from a UK perspective, like you're saying, you're speaking to someone in the US doing stocks, and you're doing property in the UK. But if we look at property and again stocks in the UK, property's always been historically been that preferred method of wealth building and that kind of vehicle for a lot of Britons, because it's, as you say, safe as houses. But of course, property values, they can become a bit disconnected for people's incomes, and rental yields could sometimes compress, and obviously all the regulatory changes that we've went through in the last few years, that could really alter your returns. We've had big changes in upgrades you need to do. You've got your lending and your interest rates changing. A lot of factors like that have come in that you need to take on board. But I think as long as you're aware of all that and work it into your numbers, you could still make property a good investment.
Definitely, I would say so. You'd said it there about sometimes it comes disconnected from the income, but to make it work, you have to actually get the numbers right. And to me, the property market is just a formulated driven risk analysis. That's it. And it's a combination of is interest rates going to go up or down? What would happen if it did? Is rent's going to go up or down? What would happen if it did? If people lost their job and everybody lost their job, where would you be? Would everybody get benefits? And how much would that benefit be? Would that be enough for the income to cover the rent? And what's your exposure to that? And then also things like the occupancy rate as well. If somebody's moving or there's not enough people and there's an oversupply of rental properties and therefore you've got a void, then where is that void and where does it hit with your breaking even? These are the sort of, and then maintenance as well, and then how much maintenance are you going to have to do over the years, and are you going to reinvest every single year a certain amount and just keep it aside, or are you going to take the gains and just take the hit when it comes? And these are the risks that you've got to assess when you do that. I think that's every asset class experiences the overvaluation and undervaluation overall. I think that's the reflection on this.
But probably a big part of your success as an investor and a property investor, Jim, is that like you're saying, this risk analysis and things, all these key indicators that you look at and you think about them being possibly a factor in your journey or in that individual investment. They're all the warning signs that a lot of people ignore, and that's probably what then ends up they end up falling short of what their expectations was, because they didn't do the proper risk analysis.
Yeah, we've probably got another 10 minutes to go here because we're on a tight schedule tonight. So let's just look at the warning signs of people often ignore.
Yes.
Periods of excessive optimism tend to lead to similar characteristics. Watch out for this. You can probably see it in AI right now. The rapid price rises, the easy credit, the high leverage, the speculative behavior, the fear of missing out, the FOMO, like I'd mentioned before. That is what can happen. The question is, can bubbles be identified while they're happening, or are they only obvious in hindsight? And I think it's while they're happening. That's just in a nutshell.
Yeah, and in real time. Yeah.
This goes back to Buffett's observation about being fearful when others are greedy and being greedy when others are fearful. That's what I think is the thing that will come back out of it. Definitely. It's these sort of things. The challenge lies not in understanding this quote, but applying it during periods of extreme emotion. Just hold back. Just take time. I don't mean delay a decision. I mean just reflect on it and make sure it is the right decision. You can build wealth in any market environment, because markets move through cycles: expansion, euphoria, contraction, recovery. See that?
Yeah.
Expansion first, euphoria comes, contraction, recovery. Crypto. Classic example. The fear of missing out. Everybody ran in. Should investors adapt their market strategy to the market conditions, or should remain constant regardless of the cycle? And I think, personally, I don't know about you, Richard, it's probably constant. Just be constant.
Consistency, yeah.
Because if the market will always be there. Because time, if you look back historically, and I do look back historically, especially in the property market, and say, it doesn't matter about the dips and ups and downs. If you look at it historically, it always goes up in a curve. There's never a point over the long term it ever goes down. And it never will. And if it does, who cares? We're all going to hell in a handbasket anyway then. So why would you care?
We're all going together, yeah.
Yeah, we're all going. So we're all going down at the same time. So why would you bother? That's the sort of thing you've got to understand. The framework it adopts to that is income plus savings minus investing, and time equals wealth. Yeah, definitely.
And that it does appear quite simple, yet very few people follow it consistently, like you said.
Yeah, income plus savings minus investing plus time. It's like that equals your wealth. That's where it happens over the long term. It's the income, the savings that you put aside, and then you invest in it, your time, and you leave it to go. The formula appears simple, yet very few people will follow it consistently.
Yeah.
And when it comes to property investment, I do. Let's finally come up to the sort of questions here. Is the market overvalued today, Richard?
Yeah, I think as we talk about the Buffett Indicator, that is, people watching or listening are probably thinking, well, is the market overvalued today? And rather than focusing on, predictions, look at and consider the actual evidence and examine the areas like, market valuations. We looked at the GDP growth, corporate earnings, interest rates, productivity trends, and of course, as we've said, technology innovations like things like AI and things as well. They will all have an effect on that.
Well, aren't current valuations then justified by future economic growth? Or are investors paying for tomorrow? So they're paying today's prices for tomorrow, aren't they?
Yeah.
And it's hope and speculation, isn't it? But that's what we're coming back to. AI and productivity, that's what it's... Everybody keeps arguing about this artificial intelligence could create economic transformation similar to the Industrial Revolution, electrification, the internet, and all the rest of it. But you have to understand, it's all very well saying that, but if productivity accelerates dramatically, today's valuations may look reasonable in hindsight, but hindsight's a great thing.
Yeah, once you're past, it's...
And I could make it really crude here and say, if your granny had balls, you wouldn't be here. Eh? Think about that.
To be completely Scottish,
that's entirely possible today, by the way, in today's environment. But it's true, isn't it? If your granny wasn't your granny and wasn't capable of having kids, then you wouldn't be here. No. So hindsight's a great thing.
But it's a lot of the time it's too late.
Yeah, definitely. So the closing statement will come from here. The real lesson of the Buffett Indicator is the Buffett Indicator is not a forecasting tool. It's a valuation tool. Yeah. Like a thermometer, it tells the temperature of the market, not what tomorrow's weather will be. What's the key takeaways then?
Yeah. Well, I mean, markets move in cycles. We've talked about that. Valuations completely matter. Emotion often destroys your returns if you make emotional decisions. Time, of course, is the greatest wealth building asset. Compounding, so important, and rewards your patience. And wealth creation is usually a marathon, not a sprint. Slow and steady wins the race, as you always say, Jim.
Yeah, that's it. Slow and steady wins the day. The thing for me, the Buffett Indicator may help explain where markets stand today, but the real detriment of wealth is the behavior of the investor.
Yeah,
that's the determination. That's where it comes from. It's the behavior investor, the emotional response. You shouldn't be emotional to it, because that is the problem here. Don't ask where the market will be next month. This is what I keep saying to people. Where do you think it's going to be? Where do you think it's going to go in? And I'm like, well, you open to taking the risk, because it could be up, it could be down.
Anyway,
maybe accurately predict it within a certain period of time. But you have to, it's almost like I say to people, it's like going into a casino and say, prepared to lose X amount of money.
Yeah.
And if you could do that and you could lose that money, then you've got every chance that you could get the gain. Yeah. So you ask where your wealth could be in the next decade is probably the things you've got to answer, rather than actually say where it's going to be in the next month overall.
Yeah.
Makes sense?
Like you're saying, in building true wealth, you need to be looking at least at this 10-year period or more. But yeah, no, that's good. I'd be interested. Obviously, we've done a few figures and things today. If people have got a different perspective or could tell us anything different, then jump in the comments. We'll be happy to hear some feedback on that. That would be good. But
everybody's saying it's like the Buffett Index. I've never heard it.
Yeah. Well, to be fair, it was new to us and it was good to cover. So any further advice on that would be quite good to hear from.
Brilliant.
People. You could jump in the comments box, and we'll see you next time.
Bye for now.
All right. Cheers, Jim. Thanks.